Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. Most of my presentation this morning is going to be about bond yields. It's all important. They have a huge effect on the pricing of assets across the world. They have an effect on global liquidity as well. The most exciting segment this morning is going to be from Alpine Macro, their analysis explaining high bond yields and the likely trajectory. Finishing off with a constructive outlook, actually corroborated by capital economics. The Alpine Macro outlook is also constructive in terms of bond yields. Now the really exciting bit, Alpine Macro, it's an article on global fixed income and currency strategy that we can read across to what to expect from equity markets. So we're going to start off, they keep talking about the R star, the neutral real interest rate. And the neutral rate is one that neither grows nor shrinks the economy. Some people call it the equilibrium rate, where we have optimum employment and no inflation threat. So when we talk about the R star in this report, we will know what that is, the neutral real interest rate. So they introduce their report. US inflation is on a clear downtrend, but the economy remains resilient, even though the Fed has raised its policy rate by 525 bips since early last year. The fear is that continued economic strength will halt the decline in inflation before it gets back to the Fed's 2% target. This concern has pushed the 10-year Treasury yield to a new cyclical high. Is the resilience a sign that R star is higher, or are the lags between monetary policy impacting the economy longer than usual? We believe R star remains depressed. The favorable effects of fiscal policy should begin to wane. Households have depleted most of their excess savings. The US lead economic indicator is collapsing, and core inflation is about to melt lower. The cyclical outlook calls for falling bond yields. China is also unleashing a deflationary impulse on the global economy, which is bullish for bonds. It's just a matter of time before the economy weakens in the US, which should pull Treasury yields much lower. Over the past 50 years, the R star has declined. Across most economies, population aging and eroding productivity growth have been the largest contributors to falling real interest rates. Productivity growth is the most difficult factor to forecast in making projections for R star. Artificial intelligence clearly has the potential to boost productivity and raise the R star. However, even if AI is as transformative as many experts say, it may be 5 to 10 years before there is any meaningful effect on productivity growth and R star. They cite the IMF's research and the New York Fed's research, and they show that the real equilibrium policy rate remains at depressed levels. Both the IMF and the New York Fed estimate that R star is holding at a multi-decade low of around 0.6%. We believe the Fed's monetary stance is very restrictive, with the policy rate well above neutral. This view is validated by the deeply inverted yield curve a contraction in the broad money supply for the first time since the 1930s, and the tightening in credit conditions. We put the current resilience of the economy to longer than usual lags for the impact of monetary policy to be felt, down to the unprecedented fiscal support following the pandemic. But the favourable effects of fiscal policy should begin to wane. Households are close to depleting the excess savings accumulated from the government handouts. So a couple of economic indicators. They mentioned earlier the Conference Board's leading economic indicator. That has contracted for the 16th consecutive month. The economy has never avoided a recession after such a long string of declines in the LEI and the current annual rate of contraction. Meanwhile, we remain convinced that US inflation will continue to head lower. How do they motivate that? Excluding shelter, core CPI has already fallen in the US from a peak of 7.6% year on year to 2.6%. New research from the San Francisco Fed confirms our outlook for much lower shelter inflation. Forecasts that shelter inflation could turn negative in the second half of 2024. If this projection plays out and core CPI excluding shelter remains exactly where it is today, i.e. at 2.6%, overall core inflation will fall to just 0.3% by late 2024, significantly below the Fed's 2% target. We believe that bond yields are indeed close to, if not already at, their cyclical tops. Bond yields could swing around their central tendency widely if a growth slowdown or even a recession occurs next year. Long bond yields will drop well below their fair value. And what is their fair value? Their bond model suggests a fair value for 10-year bond yields of around 3%. Inflation remains the key. If inflation falls quickly in the coming months, Fed rate expectations will shift downwards, leading to a sharp rally in the long end of the curve, i.e. sharp falls in long-dated Treasury bond yields. Now we turn to capital economics. They corroborate that view. This is my last segment. So capital economics still expect Treasury yields to fall despite the recent hiatus. We think the 10-year Treasury yield will end the year well below its current yield. The timing of the rise in yields relative to the hiking cycle was arguably a bit unusual. After all, the 10-year yield hasn't peaked after the final Fed rate hike since the early 1980s. The 10-year yield fell by an average of 130 basis points in the 6 months following the ends of the past 8 tightening cycles. Despite the rise in yields, investors seem to agree with us. There's still only a fairly small chance of another hike discounted in market, and expectations for the peak Fed funds rate have been remarkably stable over the past few weeks. So what's made this time different? It reflected higher term premia due to unrelated factors. The Bank of Japan's tweak to yield curve control and the Treasury's larger than expected issuance plans have probably boosted Treasury term premia. And also, economic growth has proven remarkably resilient. So what is the outlook? We remain of the view that the 10-year yield will fall substantially over time for 2 key reasons. First, we think that falling inflation will give the Fed the confidence to cut next year by more than the market is anticipating. Second, we think growth will eventually falter. Monetary policy operates with a lag, and we still think it will take a toll on activity. We're sticking for now with our forecast for the 10-year Treasury yield of 3.25% by end 2023 and 3% by end 2024, very close to the fair value levels of Alpine macro. All right then, Gielie, over to you then.
Hi, Nick. Thank you very much again for your macro overview. Always very interesting. I always enjoy it. We can go straight to the statistics. Is the retail sales year on year. That went up. So it went up from minus 1.6 to minus 9%. So it's still in a minus position, but it's less of a minus, it's more positive. Then the SACI Business Confidence Index, that came out for June and for July. The June one is up from 107 to 109, and then the July one came down from 109 to 107. The leading business indicator, that indicates what we can expect, what's going to happen. This one is also up. It's moved from minus 1.7% to minus 1%. So it's still in minus territory, but it is better. Nick, you also asked me to say something about BRICS, but I think we must first just start with the G7 countries. These G7 countries that is in existence for a long time, and they have quite some clout in the business world. The G7 countries are the United States, Canada, the UK, Germany, France, Italy, and Spain. And there was an article written in 2001 by an economist of Goldman Sachs that there should be there's 4 other countries, that could be stronger perhaps as the G7. And these 4 countries were Brazil, Russia, China, and India. And those countries actually came together and they formed BRIC. Without the S, South Africa wasn't in yet. At that stage, when they talked about BRICS, it was BRICS with a small letter, a lowercase letter. When South Africa joined, it's still BRICS, but then the S became a capital letter. South Africa joined in 2010, and the difference between BRICS and the G7 is that the G7 are developed nations, and the BRICS countries are all emerging market countries. You can say they are in opposition to the G7, but at the moment the BRICS, the GDP is already bigger than the GDP of the G7. There's only 5 countries, but the GDP of these 5 countries has now leapfrogged the GDP of the G7 countries. They're getting stronger. They've got a BRICS bank already. They've achieved that. And they are opposition to the G7, but I think they're also very anti-G7. They don't like, for instance, the petrodollar. That's out for them. They want to create their own unit of petrol payment method, and they will probably use the yuan, the Chinese yuan for that. So it will be a yuan petro money. Oh yes, for the name, it's BRICS at the moment, but there's several other countries, about 20 at the moment, that also want to join BRICS, and they are all emerging market countries. They will join it. There won't be a name change at BRICS. It will just become BRICS with a plus sign at the back, so it will be BRICS plus. It's very much like OPEC. OPEC is a few countries, but when you include all the countries in OPEC, it becomes OPEC plus. That's all that I can tell you at the moment, Nick. It's just an interesting thing to watch.